Welcome to Better Conversations. Today we have my right-hand man, so to speak, Michael Boyle, with us today. Michael's been an advisor with me for 2.5 years, just completed his certified financial planner requirements. And hey, let's talk about the biz, Michael. Let's have a better conversation. Welcome.
Thank you. Excited to get to it.
Yeah. So tell us, what's different from being on this side of the desk versus the other side as a client? After 2.5 years, you've been now in over 400, maybe 450 client meetings.
Crazy.
Yeah. What's different? What have you learned? What's jumped out at you as being maybe different than what you expected originally coming into this business?
Yeah, I would say from an outside perspective, you think, all right, we're going to have these client conversations. They're going to be really detailed analysis, spreadsheets, calculators, a lot of data, financial planning models. And that's a piece of it. But I think the part that I didn't realize was how much emotion is driven behind all these money decision makings and how much involvement we have with trying to pull out the emotion from people and have them understand the emotion that's driven behind these decisions and try to peel that away so that they can make better smart moves, smart money moves.
One of the books that it's been most important to me in my career for 30 years now is a book called Winning the Loser's Game by Charles Ellis. It's still one of my favorite books on investing and in finance, but Winning the Loser's Game is the title of the book. And what he talks about in this book is that investing is a loser's game. In other words, it's a matter of not trying to be fancy and outsmart everybody, but really it's more of a process of avoiding self-destructive mistakes.
Right, exactly.
And in the book, he compares investing to tennis. Tennis has been analyzed endlessly, and what's been determined is that about 80% of points in a tennis match are lost, not won. So for amateur tennis players, most tennis players are giving their opponent points constantly rather than acing them. They're hitting into the net, they're double faulting, so forth. And so in investing, it becomes mastering these mental mistakes, these emotions that you talk about.
Yes.
Yeah. Have you seen that? You've noticed that already?
Definitely, exactly. And I have a few examples that come to mind and we can go through them. But the first one I'm thinking about is how people hold on to things that just don't fit them anymore. And I'll give you an analogy and then we'll bring it back to investors. But I've known my wife for almost 10 years now. And I guarantee you, if I go into my closet right now, I'm going to find a few pieces of clothing that she's never seen me wear. And why is that? Why do I still hold on to those clothing items? It might be because I have some regret of the purchase, or maybe there's some hope that sometime in the future that there's going to be that perfect moment. I'm going to wear it again. But in reality, if I had the cash right now and I didn't have that piece of clothing, I probably wouldn't go back out and buy it. So this correlates to investing, whether it's people holding on to grandpa's inheritance or there's some concentrated stock position from a business that they used to work at, or maybe they just don't want to pay the tax on a big gain that they have, or they're just feeling regret for a loss.
I think universally we love to win. Mm-hmm. We hate to lose even more. And so there's this idea that people are holding on to something. The analogy, I think, whether it's in your wardrobe or an investment, but the rule of thumb that I've always had is a decision to hold an investment today for another day, a month, or even a year or longer. But a decision to hold anything that you own today is really the same as a decision to buy it today if you had the cash.
Right.
And so often, as you mentioned, clients are hanging on to stuff. I think because this loss aversion that sometimes they don't want to pay taxes. Sometimes they've made a mistake and regret the investment they have. And I think we've just learned, and we know academically, that the pain of realizing a loss is about twice as powerful as the joy that we receive as an equivalent gain. So people are trying to avoid the pain of getting rid of what they have.
Right. And the decision that they had when they bought it originally may no longer fit the situation that they're in right now. And and not a lot of times you think about where you're at now versus where you were when you made the purchase or the investment decision.
Yeah. So this isn't really an intelligence question, right? This is more of a mental. It's just emotions, and and they're super powerful. So, yeah, sometimes we call it also the overnight test. I think there's a financial planner in our industry by the name of Carl Richards. He's also an author. He just does tremendous work, but he's kind of coined that too, the overnight test. Tell us about that, Michael. What would you call the overnight test?
Yeah, so the overnight test is, let's say someone sold a position in a stock that you had overnight while you were sleeping, and then you wake up and you have the cash for it. Would you then make the decision to go buy that exact same thing if you had the money to go buy it? Most of the time, it might be no, but if the answer is no, then that's when you should make the decision to get rid of it.
So this is a mental mistake. Oftentimes, people don't want to let go and pay taxes, or there's an attachment to some story, or just maybe they realize they made a mistake and we hate to admit that by closing out the position. But we see that all the time. But that's holding on is kind of an emotional barrier to good investment results. But that happens after you made the investment or received it. There's also emotions that come in before you buy.
Yes.
And you were talking about, what have you noticed in that in the first few years of your career after hundreds of meetings?
Yeah. So a lot of times people will confuse whether they're making an investment decision as actually speculating on a decision. So there's a confusion between what investing is versus speculating is.
Okay. So in investing, you're saying investing, you've realized is different than speculating.
Yeah.
Which may or not be different than trading.
Right. So let's go into an example here. Let's say that you were really convicted on this one particular hot stock, and you got rid of all your investments and you invested directly into this one hot stock. And let's say that it worked out for you. You doubled your investment and you got a great outcome at it. Was that a good decision originally?
That's interesting. I think people just want to make money.
Yeah, so people are more focused on...
They just want stuff to go up.
Yeah, they're more focused on what the outcome is versus what the process was, the investing process along that should have gone ahead of that.
So the difference between speculating and investing, here's how we think about it, how I've always thought about it, which is an investment is something that you can manage to be either more profitable, and you can make it less profitable. But an investment is something that can be managed, and you can influence the value of that allocation of your money. So that could be a piece of real estate. It could be an apartment building. You can raise rents. You can renovate it. There's all things you can do to an apartment building, for example, to make it more valuable or less valuable. Businesses are the same way. Businesses can be managed. But beyond that, an investment is something that can be valued. Right? You can determine whether or not it's undervalued or overvalued. And a speculation, you cannot.
Right.
A speculation is anything you put your money into that you cannot affect, or someone else that you pay to manage it cannot affect the value of it.
Right. You're just hoping that someone will pay more for it than what you paid for it.
Right. You're just literally betting on an outcome versus a process, right?
Right.
It's not that speculating is inherently bad.
No.
But we don't deal with speculations, right? So speculative investments are commodities, whether it's oil or cattle futures, or I would even argue precious metals, corn, soybean, all kinds of things like that. And it can just be an unproven stock. So your example of this person that put all their life savings into one stock, may not have been a good decision, got a good outcome.
Right.
But that's a red flag.
And they're basically getting rewarded for making what we would consider a bad decision. And that happens often.
Yeah.
Another one that always comes up, that I'd say always comes up, but it's pretty often that you see is people feeling the fluctuation of the markets and confusing that with loss. So you might hear the phrase, if the market's down a little bit, someone say, I lost X amount of dollars. And what they're doing is they're confusing all the normal fluctuations that we have with the market with taking a loss in their position. And what that actually is it's the fluctuation is just the fee that we pay to get those outsized returns on the other side. And you can compare this to, I'm a pilot, so I love flying. My family and I take a lot of trips. And what we know when we fly is that oftentimes there's going to be turbulence, but we're not surprised by the turbulence. And oftentimes the pilot will come on, hey, we're going to hit a little bit of turbulence here, but it's really going to be okay. We're still going to reach our destination and the plane's not going to crash because of the turbulence.
Planes don't fall out of the sky because of turbulence.
Right, exactly. The only time there's going to be loss on an airplane flight when there's turbulence is if you decide, I can't handle this anymore. I'm putting on my parachute and I'm going to jump out.
Well, that is what I call a wooey, Michael. You've heard me say it, a weird unconscious equation or wooey. This weird unconscious equation is that fluctuation equals loss. It's just fluctuation, right?
Yeah.
But we hear that, for example, all the time with people. I'm a real estate investor as well, but we hear this all the time with clients that they want to just buy real estate because it doesn't fluctuate like the stock market.
Or it doesn't seem like it fluctuates like the stock market.
Yeah. And that's fascinating to us because it's not that real estate doesn't fluctuate. It's just that you can't sell it.
Right. If there was somebody on your lawn every single day trying to value your house and you seeing what the price of your house is every single day, that would stress you out a lot more than when you just are long-term. You think long-term about your house, you're not going to sell it today. So it doesn't matter what the price is.
So can you imagine if you had a Zillow account, if you looked on Zillow and pulled up your house and every 15 seconds of the day, there was an auction going on and what their house is worth, it would probably change your perspective on whether or not real estate's, doesn't fluctuate.
Yeah.
The reason it doesn't fluctuate is because there's no auction. So the stock market by nature is an auction, and every day there's buyers and sellers determining the value of a company. And every day at 2:00 Mountain Time, 4:00 Eastern, every company has to be valued for what it's worth today in the market. And so you get these changing prices, but it's just fluctuation. It doesn't mean the house is worth less or necessarily that the true value of a company is lost, so to speak.
Yeah. And take that a little further. One thing I don't know if I would use the word surprise, but one thing that I've noticed is that when markets do decline, our office is pretty quiet. We don't get a lot of phone calls. And I think there's a reason for that. Can you explain it?
We've just tried to do a really good job of helping our clients understand what to expect and what this fluctuation is normal. So we absolutely believe that if you're surprised by what's happening at any time, you're likely to get concerned and maybe even panic. And if you panic, jump out of the plane, right? You might lose. And if you might lose, and if you're not in to get the recovery, you're probably going to be disappointed. So if we're not surprised, we likely won't panic. If we don't panic, we'll probably catch the recovery, and the outcome will ultimately be more what you expect. So the key is just not to get surprised. And I think we do a really great job of our clients of understanding what to expect and not being surprised. And so I hear that too, Michael, all the time when I'm out and about. People think that our phones are ringing off the hook with clients that are panicking, and you found over 400 meetings, and that's just not the case, right?
Right, exactly. Yeah, we're telling them the turbulence is going to come at some point, and it's okay. The plane's not going to crash. Yeah,
I think clients like that. I love it on the airplane when the pilot tells me, "Hey, we're going to have turbulence. It's going to last about this long, and keep your seatbelt buckled."
Right,
and then we're not surprised, and it's much easier to go through. So
another example is there's a lot of times people will confuse, and these two terms interchangeably. They'll say, I have got, let's say, $1 million, and I just want to keep it safe, so I'm going to put it in the bank. And what they're doing in the long term, they're confusing safety versus certainty. So that $1 million, you're right, is certainly going to be $1 million in the long term, but is that safe?
Yeah, that's another woo-wee, Michael. Weird and conscious equation.
Mm-hmm.
And you're defining it differently versus safety versus what? Certainty?
Right.
Yeah. So safety to us is preserving what your money will buy. Certainty is preserving the number of dollars you own, the number of currency units, right? The number of dollars, right?
Yeah. Yeah. Because if that $1 million, if you're a long-term investor and you want to keep it safe, what's going to happen over long term, what we know is that inflation is going to erode the value of it. So in 20, 30 years, everything that you want to buy is going to be cost twice as much in 20, 30 years. So that $1 million is going to only be able to buy half. So really, you've just lost half of your money by holding it.
So if you don't keep up with inflation, you're really losing money, right? So what are you saying, that bonds aren't safe?
I'm saying that they're not safe, but the best investment to keep your money safe is to be invested in the best businesses in the world, because they're going to continue to manage to get an outsized return that's going to keep you safe over the long term.
Yeah, so I'd maybe argue that safety, certainly bonds are certain.
Mm-hmm.
Typically, you can know exactly how much interest you're going to earn and maybe when you're going to get your money back, like a CD at the bank, so forth. There's a maturity date.
Yeah.
And so there's certainty to that. But long term, they're not necessarily safe. But short term, they might be. So safe, the definition of safety kind of changes over time. It kind of rolls over on itself. In the short term, bonds could be safe because inflation may not go that much up in the next few years, and it's very certain. So bonds can be safe in the short term, but the long term, that definition of safety really changes, doesn't it?
Right. You're introducing a new risk, which is inflation.
Yeah. So there's no such thing as no risk.
Right.
It's just, how does the risk change?
Okay. So I've got one more example that's a fun one, but
What, a client that you've realized from clients?
Yep. So people watch too much news. And then they think that based on what's on the news, they need to take action on it. But what the reality is news, I would just change the word news to entertainment, because what they're trying to do is keep you entertained. So what they need to do with that is introduce greed or fear, just these feelings and emotions. And what a lot of people do is they take those emotions and they think they need to make action or take action on their long-term investments.
So turn off the TV.
Or just don't think about it as something you need to take action on.
Yeah, I think it's a mental mistake to think that in general, journalism's out here to help us become better investors, right?
Right.
I mean, media's job is not to help people become better investors. Their job is to create clicks and viewership and to create advertising revenue. So the more they get you sensationalized, the more they stoke your greed and fear, the better they do.
Exactly. Yep.
I can't think of any instance where listening to the news has turned out to be a good thing to make you a better investor. Can you?
No. At the end of the day, it's just noise.
Yeah. There might be one case where maybe you learn about some new tax law changes. There's something you can do with tax law.
Mm-hmm.
But other than income tax law, I can't think of any scenario where listening to the news has made you a better investor.
No, I agree.
So again, winning the loser's game. Part of that isn't just about how to outsmart other investors, but one way to do that is just to pay attention to what matters and not all the noise going on around us.
Agreed.
Yeah. Michael, I think these are interesting. I think these are provocative thoughts that you've come to realize, epiphanies, so to speak, in your first
absolutely
2.5, 3 years in this industry. And I agree with them wholeheartedly. So, so many times clients feel like our job is to be simply managing money and outsmarting the markets. And, the reality is most of our job is helping clients understand and manage their own emotions and their behavior around their money. That's probably 80% of our job. Wouldn't you agree?
Yes, exactly. And emotion is such a bad advisor.
Yeah. Emotions are terrible financial advisors.
Exactly.
So there's a lot of more examples I think we could share with what it means to win the loser's game. And in future episodes, I hope to unpack those and learn more about them. But Michael, I appreciate you joining us today.
Yeah, it's been really fun.
Yeah. Appreciate the better conversation. And we'll see you next time. Thanks for listening.
Thank you for listening to Better Conversations, the Life and Money podcast with Eric Lee from Purple Wealth. If this episode sparked something for you, follow the show so you never miss a conversation. You can learn more at www.purplewealth.com or reach out directly. We'd love to hear your thoughts. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Purple Wealth is a separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any guests and their companies are not affiliated with or endorsed by LPL Financial or Purple Wealth. Individual tax or legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.